Welcome to the Weekly Trend, a podcast for navigating the markets through the lens of technical analysis. The Weekly Trend podcast is provided for educational purposes only and does not constitute any professional advice. Listeners should not act upon the information or content without first seeking advice from a registered financial planner.
Welcome back to the Weekly Trend podcast. Today is Friday, October 20th, 2023. S&P 500 currently sitting at 42.49. I'm David Zarling. I'm here with our resident starting lineup expert, Ian McMillan. Where should we start? Plenty to cover.
Yeah, quite a bit of volatility yet again this week in the market. Now I say that with a VIX at 20, so it's not like this is some rare event.
Yeah, can you walk us through that? We're talking about the VIX. It's a volatility measurement, right? It looks at the prospects of S&P volatility going forward, right? So it's a 30-day. And is there like a general rule of thumb that you're saying the VIX is at 20? So that means what? What does that mean if the VIX is at 20?
It's just like a lower, pretty average VIX reading as far as volatility.
Okay.
It's not like an historical extreme or something we don't. I mean, we see 20 probably every year.
Right.
So when I say high volatility, it's not like anything crazy. Although yesterday had a lot of intraday volatility, but another down week for stocks.
Yep. Another down week. I think your point with the volatility measurement of the S&P 500 is just looking at the coming 30 days, using it as a measurement of level of risk or fear or stress. And I know in the past on here, and it's been a while since we've talked about this though, I think there's a general rule that you can divide by 16 the value of the VIX. So 20 divided by 16, right? We're expecting more than 1% moves in something like the S&P 500. And that's what we're getting another day today. Typically higher VIX means lower prices. Doesn't have to be, but just increased volatility typically means lower prices. And like you said, we got follow through this week from last week. Continues to be in October that using something like the S&P 500 is currently sitting below the September lows. So currently sitting negative for October. And we're up against important levels across the board. You want to cover any of those levels that stick out to you, Ian?
You said above certain levels?
Yeah. If you look at something like the S&P 500.
We're still above 4180, bouncing off the 200-day here this afternoon again for the second time in, I guess we were back near the 200-day, like at the beginning of the month, I think. Yeah. So painful. I think we had just one 80% down day this week. Was there one on?
Well, I believe actually there was.
Monday?
It's really interesting because I actually think we had
One
two of those days this week that wiped out some previous strength that we saw.
Deemer had a good tweet on that.
Yeah. And so, for example, going back to last week, October 12th was a 80+% down day. Same with October 18th, 2 days ago. Mm-hmm. And those kind of wiped out some of the bigger days we saw, such as October 16th, which was a 85+% up day. And October 10th was an 80+% up day.
Okay.
So this huge sloshing of breath.
Yes. Very extreme, both ends.
Moving in both directions, love him or hate him, a guy like George Soros would say short-term volatility is largest at turning points. Now, we could all sit here and be like, well, which turning point are we talking about? There's evidence for both sides. I mean, yes, we're above 4180, a rising 200-day and something like S&P 500. Yet at the same time, you look at an equal weight S&P 500 or an equal weight Russell 1000, and we're below a 200-day moving average and up against horizontal levels that need to hold.
Yeah. And I mean, Russell, right? Probably, as we've said, the most suspect of all of them. It did have the worst week. We're now back to essentially where we were a year ago, that October 13-ish area, not necessarily a V bottom for the Russell. It had actually kind of gotten down there a couple weeks prior as well. But yeah, all of that given up. We've talked about how this was the, year in, this would have been the weakest return, if we were in a new bull market, then this would be the weakest start for the Russell. And you've seen that all year. I mean, we saw that at 6 months, we saw that. And, again, there's been different time frames on that people have shared throughout the year, just pointing out that, holy cow, if this is going to be for real, then you would expect a lot more from this bucket of 2,000 stocks, which I would agree with. Obviously, we agree with that. And here we are. They've given everything back. Micro caps, obviously, even worse.
Yeah, breaking down the downside. And to your point, it's not even the Russell. When we look back to 1980, there was a chart we shared with our clients at the Lunch and Learn this week that this is also the weakest response out of an equal weight index and the S&P 500 since 1980. And now we're sitting at a 0% response for the Russell 2000 since the October low, an equal weight that's borderline 0%, and the S&P 500 being the best performer, taking the NASDAQ out of that equation.
Yeah.
But that's also around 20%, 18% is the weakest response we've seen from a bear market low going back to 1980. So we're not out of the woods yet by any means.
Caps are back to that. You remember like 2020, we had that range, August, September, October, and then November, things took off.
Mm-hmm.
Yeah, we've got micro caps back to that range below their pre-COVID, their February 2020 highs.
Yep.
It is, we're kind of getting into pretty sketchy territory again. NYA composite, that failed breakout that we talked about above 16,000 or 16,100, wherever you want to draw your line. That
surprise, end of July, right?
Yep. And that has had impressive follow through. We've down another 7-8% from that. Talked about the Dow, right? The Dow, the failed breakout, couldn't hold 34,000 or 34, 35 again, wherever you want to draw your line with your crown, 34.5 and 34.5. That's continued to have follow through. An unfortunate look for sure.
There's a lot of stocks that are now negative on the year. You look at something like international stocks that were a leader early on.
I remember that. In fact, we owned VGK for a little bit.
Yeah. We owned some Japan. Too. And I'm not saying Japan isn't still.
Look what happened to our Argentina and Mexico friends.
Yeah, maybe we should have cried for them. Japan was a great trade. It continues to be positive for the year. But when we look at international, like as a bucket, like looking at something like VEU, now negative on the year.
Argentina was beautiful.
Yeah.
I'm sitting through that consolidation. And now, using ARGT through the 200-day, we came back up into this 41, 42 area.
That looks like that has some destiny with 36.
Yeah, it has. I hope they fix it. They fix it.
But from a time series, if we were using symmetry for something like ARGT, the fact that we go visit 36 doesn't seem that far-fetched. And that could take all the way into 2024 to do that, all the way into like February. Maybe even we would call it Valentine's Day, that you would see Argentina base or like retest this massive base that goes back to 2018. But until then, your basic point is why take on risk there when it's an opportunity cost? We're below a 200-day moving average. We're below important levels. Let this thing figure itself out. And if it wants to participate again, it's going to be at a different level.
Valentine's Day. Does the whole world celebrate Valentine's Day?
That's a great question.
I think they do.
Do they? Like same day? Like, how like Canada and the United States have different days for Thanksgiving? Like it wasn't
from my neighbor that they have their own Halloween, but it's in February.
Because Thanksgiving was early October, I think, for Canada.
Yes, they recently had it. They've definitely recently had Thanksgiving.
Yeah. So, I feel like dual citizenship, you get to hit that family meal buffet twice.
Speaking of Canada,
okay,
I saw this chart before we hopped on, but Bitcoin versus the Canadian dollar looks better than Bitcoin versus the US dollar, which makes sense. If you're out there on your Coinbase account, buy your Bitcoin in
Canadian dollars. That's fascinating.
The weaker currency than US dollars.
What I appreciate about this is we haven't talked about crypto in a long time.
It's holding up
B,
well.
B, you're breaking this down in another currency, which is fun. And what Ian is painting here is if you look at Bitcoin priced in Canadian dollars, why does it look like that on my screen? When I look at it, BTC, USD versus CAD or
I'll put
CAD.
BTC CAD.
Okay. Yeah. It's looking good.
It's a nice, I mean, it's been consolidating for.
And you've got a 40,470 spot on that, right? Like the price on that. Yep.
That's true. You do have to pay more. You are paying Canadian dollars versus.
I think the comparison is worth it though.
Relative. No, that's right. Yeah.
It's an interesting dynamic where, and I think maybe this could lead us into some other conversations, even commodity wise, because the currency it's priced in matters. And for example, we haven't given a lot of attention to gold on this show, and for very good reason for a while, just because it's either been in a downtrend or a sideways trend, or no trend is what I should say. But in a lot of currencies, gold has been moving to the upside.
Gold looks good.
I want us to pause for a second and just hear what Ian just said.
I'm a realist, so I definitely, if you listen to this podcast, like to poo-poo on the precious metals sometimes, but could this be the beginning of something new? We'll see. Now, it's got to happen on a relative basis too, but yeah, gold, big move. And this would be the beginning. We're like, this would be, I had a big move last week, yes, but this would be the, follow through, we'll call it. Still not above 2050 dollars, 2040, again, wherever you want to draw your line, but knocking on the door maybe. And this would be, you would think that if we get above these July 2020 highs, maybe decent pent up energy.
There is, because this energy that Ian's talking about goes on for 3 years of sideways range, which is not actually that unfamiliar to some of the equity space as well, but it's also happening around the 2011 highs. And I love that you're pointing out that you're a realist. You're not saying, oh, gold has to go up, or you're not saying I'm a gold bug. You're not saying I hate gold. You're saying, listen, if we're going to be above 2,100 on gold futures, how can you complain about that?
The relative charts got a little bit of work to do, right? And when relative against S&P, guess it also depends on what the denominator does, and do you get to relative highs? So what I'm kind of wondering is, are we going to get to 2040, but the relative breakout's not going to be there yet?
That's fair. You're just saying opportunity cost.
Yeah.
Hey, this is great.
This is great. I'm so happy for you gold people.
Yeah.
We're at 12-year highs, 13-year highs.
But is this where we should be putting money to work if it's going to be outpaced by something like the S&P 500?
Yeah. Or, and I hate to be a zoomer, but it could be just Bitcoin. Bitcoin is gold.
Could be.
They could both make a move. And if you got to pick one, right, you're going to pick one that's outperforming.
Right. It's an interesting discussion to consider Bitcoin versus gold. You can look at a relative chart of that. For those not familiar, if this is your first time listening to this.
That to your grandmother.
Oh, yeah. Well, I would love that opportunity. I think.
What? I didn't mean that in a.
No. I'm saying, I think all of us should be talking about those things with our relatives. As far, I wasn't going Debbie Downer. I was just saying.
Do you think we'll have what's the, on CNBC, what's that gold company? They always run the ads.
Oh, man.
And they've got that old actor guy.
Oh, wait. It's not the guy who does the Quaker Oats. It's not that guy, is it? It's not like Comex, is it? Comex?
No, it's like the gold. They always do the commercials now. Maybe they don't anymore. I haven't watched CNBC in a long time. Long time.
I was going to say, because I haven't, I was like, I know they're always pitching gold coins and gold things on CNBC. I don't really watch CNBC. I understand they have a job to do, but you're saying that there's some commercials they used to do that had a famous actor. I guess I don't know who the company is.
It's an older gentleman with gray hair. So there you go. 100 million people.
That's
But it's
great.
like a specific, like not Raglan Gold.
Is it one of the main mining companies? No.
No, it's not like an actual stock.
We're going to figure this out. We are not letting our listeners leave. Everyone's going to stay here.
Lear Gold, Lear Capital.
Lear Capital.
Lear, yeah. I think that's you.
Everybody,
would the actor guy.
everybody's staying on here. No one.
We
We're not.
We don't need to go down that rabbit hole for here it is. Here it is. Roslyn Capital. Roslyn Capital.
Roslyn Capital. And they do a lot of commercials on. Oh, sure it is. Sure enough. Roslyn Capital.
And is William Devane.
Oh, William Devane. Oh, yeah. People know this guy.
Yeah. And he's always
sure.
on the CNBC. And so what's the new age? We're going to have like Ashton Kutcher selling Bitcoin in 20 years to unsuspecting millennials who are scared. You know, we'll probably have 4 proxy wars going on at that time. So lots of fear going around.
I mean, who doesn't remember William Devane and Knots Landing? And you're just saying Ashton Kutcher.
Yeah, or anyone. I mean, any type of like B-list, C-list celebrity.
I love it. Ashton Kutcher from Dude, Where's My Car?
Yes.
I mean, why would you not put him in charge of Bitcoin? I love it. Boy, I hope everybody's still listening.
Yeah, we might have lost some people.
That's okay. That's okay.
All right, back on topic.
So actually, you probably had a point with that, and maybe it was we're going to see gold and Bitcoin.
Yeah, it could be right. So this is going to be with this environments. People are like, oh my God, you know, all these geopolitical things. Gold always gets a little bit of special attention when things go nuts politically.
And your point is, if we do see a breakout in gold and it starts to rise, the gold bugs are going to come out everywhere. They're going to just be crawling over the walls.
And I'm saying that while gold might outperform, maybe also have your grandson or grandchild set you up with a Coinbase account so you could buy Bitcoin instead, because it might do better.
Right. It's a fair point. And then you compare both versus S&P, and your point there is also valid of, well, maybe we still want to be owning the S&P. Time will tell. I mean, there's some basing here that could take place. But the point is that gold, using gold futures, has underperformed the S&P since 2011 by 78%. And so you gave up some opportunity cost there if you were stuck on, oh, I can only own gold and that's all I'm going to own. We have to be flexible and adaptive to different market environments. And is this a market environment where we see gold start out to pay stocks?
Or there's a product that could be adaptive for me.
Yeah, that's a great time for us to highlight the supporter of this podcast, the Adaptive Select ETF listed on the NYSE under ticker ADPV, which helps investors access 2 of the most prevalent factors in markets, momentum and relative strength. Through proprietary identification methods, the Adaptive Select ETF attempts to own the strongest 25 large cap stocks when the market is in an uptrend. And since not all market environments are the same, Adaptive Select seeks to prevent extended declines by moving to short-term treasury bills and cash during long-term market downtrends. Investors can find out more, including how to invest in ADPV, by visiting adpvetf.com or calling 1-833-880-5200. As always, investing involves risk, including possible loss of principal. ADPV is distributed by Quasar Distributors, LLC. Ian, that's like the best you've set up.
That was a good one.
Yeah, you did a great job. You teed that up.
If we were playing volleyball, I gave you the set and then you spiked it.
Yeah.
Spiked it to win the match.
Yep. And shout out to the Badger women for representing volleyball very well.
Did they win again?
Well, they're just incredible. They're number one. I think I actually have to look at, because I'm not as versed as I should be, on when some of these matches ends up. Who did they play last? 18-0? Man.
Hey,
that's incredible.
In anything you do.
That's incredible.
pretty dang good.
And they are like straight up. And I would love to know, and I should know this. My wife is a very good volleyball player in college. What it's called when you 3-0, like when you take
like a sweep type thing.
Yeah, I should know the term for that. But the three that have given the run for the money is Arkansas, Tennessee, and Florida. And they next play Nebraska. That should be a good one.
Shout out to Kelly Sheffield.
Mm-hmm.
It's the head coach there. It's been their decade.
Yep. They are on a tear.
They missed the NCAA tournament for 5 straight years before her. Have they always had a good volleyball program?
Yes.
Okay.
Yep. They have the Badgers. Nebraska is a notorious rivalry in volleyball. And I would say if you want to lose, and maybe it's not losing, if you want to lose 30 minutes of your life and you want to look up Badger volleyball highlights from 2023, there's some epic volleys. It's pretty incredible. So we've done a good job getting sidetracked very well.
Sorry, it's not a sports podcast.
No, if you were going to tell me that in the same podcast that we were going to bring up Ashton Kutcher, William Devane, and Badger women's volleyball, I wouldn't have. I guess everything's a non-zero chance, but I wouldn't have put us there.
I was not on my bingo card.
So let's talk about some of the important levels at the Lunch and Learn this week. Ad nauseum, the one slide in the slide deck was the S&P 500, the 200-day moving average, and 4180. It's something we've written to our clients over and over and over again in our market write-ups. You know, there's an old adage in communication that says, say it 7 times to make it stick. We've said it more than 7 times. That is incredibly important. And I would say equally important is small caps holding the 165 to 170 level. We need to see that hold for the seasonality to thesis, seasonality being a strong November, December, January, February, March, April. For that thesis to be valid, you have to hold those levels. That's just numbers. It's just math. You can't say we're moving higher unless you're moving higher.
And these last 2 weekly candles on the Russell, now we've got, an hour and 45 minutes left, but yikes.
You know, whether you're using futures or a product like IWM is right at near its October lows. You look at futures that are breaking below the October 22 lows, microcaps breaking down. And I think then the story becomes, okay, we know what the leadership during this period out of October was. It was the mega caps. And we've talked about this in the past episodes. When you look at the leadership out of here, if we're going to see a major correction, because we've talked about October being an amplifier, it doesn't have to be a bear killer. It just directionally amplifies. It could be the downside, it can be the upside. Don't we really need to analyze things like Apple, Microsoft, Google, Amazon, those type of stocks? So what are we seeing out of those bigger?
Tesla got hit.
Yep.
And have followed through today. That rate of trend was broken earlier in the week.
You're talking about the rate of trend from January for the whole year?
Yeah.
You're connecting the lows from January to the lows in May to the lows in August.
So that snapped this week, and we're back to this 206.
Yeah, it's right at its 200-day moving average.
Yeah.
And I think that's one thing to be aware of is that when we look at a lot of stocks within the S&P 500 have a rising 200-day moving average. And we're now coming back and testing that level. You look at something like the measurement of percentage of stocks in the S&P 500 that are above a 50-day moving average. We tested that level that's around 10 or 15% of stocks in the S&P were above their 50-day as recently as the end of September, early October. We're now seeing about 28% of stocks in the S&P above their 200-day moving average. Now,
so that's pretty lame.
It is pretty lame. And at the same time, there's this dynamic of stocks with a rising 200-day. And I got that number actually wrong. The number I was using was 150-day moving average. The 200-day moving average, the percentage of stocks in the S&P 500 above a 200-day moving average is about 33. Not that much better.
Still pretty
lame.
Pretty blah.
pretty blah. The interesting part is that's happening with a lot of rising 200 days.
It is.
And so you have a lot of things that are testing back into their 200 day, maybe overthrowing them. Now, you could call that a breath reset. You could also say nothing good happens below a 200 day moving average. It really doesn't. When you look at corrections that happen, once you're below a 200 day moving average, not every price movement below a 200 day moving average means a big correction, but every correction has moved below the 200 day moving average.
Agree. I would say that. Yeah, it's kind of hands off the wheel. Maybe it recovers, which is awesome, and maybe it doesn't. But until it's kind of one of those things, it's look, until you're above it, like why bother? And can you get chopped up? Yeah, because that's part of markets.
Right.
But certainly you do mentally you move into the why bother? Why? Especially if there's other things that are above their 200 day. Go find those.
Yeah. And for every Tesla that responded negatively to their earnings, right? Because we don't care. Like, I want to be careful. Like, yes, I care about earnings, but not in the way you think. It's about the price reaction to earnings that we care about. And for every Tesla, there's something like a Netflix. And Netflix this week, it had pierced through its 200 day moving average, a rising 200 day moving average. And the response out of that was opposite of Tesla. Now, Tesla obviously is larger than Netflix from a cap weighting perspective. And so that is important information. But when we think about Microsoft, Apple, these are the big guys. And they are, like, for example, Microsoft struggling near its highs from 2021, holding on to a rising 50-day moving average, above a rising 200-day moving average. You've got Apple also correcting since end of July, into the highs that go back to 21 and 22, coming into its rising 200-day moving average. It's not like these setups are like short obvious, meaning like, oh man, we have to short Apple, we have to short Microsoft here. You're taking on a lot of risk if that's your thesis, unless you have price levels that you're going to use. And one of those could be a 200-day moving average. It could be a prior high that you're going to use. I'm not really here to recommend what you should do. But when you look at the really big cap names, you have to ask yourself, okay, are we going to catch down? Are we going to move? Right? Because we've seen micro caps, which are risk on, risk off barometer, break down. Small caps are right on the verge. They don't have to do that. But wouldn't the next logical step then be these mega caps have to follow? And that's where we need to see, I don't know. Google's not, all of these are not to new highs, with the exception of Apple, which then failed to hold the new highs. So it's kind of a mixed bag.
Yeah. Zuckerberg's hanging up there.
Yeah.
He's okay. He looks okay.
Right.
Hey, one thing that we need to touch on, clients will be familiar with this chart. Next week when we send you the monthly letter, I'll put an updated chart of that in there. But the yield curve.
Yeah. What do you think about that? You shared that with the team this week.
On a weekly basis, it's moving higher.
And that's typically been coincident with lower equity prices, at least for the past 40 years.
And there can be, but yes. So it is a relationship. I don't have data on, I'm sure I could go find it, but typically when it uninverts is when you see weakness in equity prices. We were close at the end of last month. I would say that has been surpassed, and now it doesn't have to mean anything. We could certainly have a fake out, but we are heading in the direction where we typically have seen, again, to your point, over the last 40 years. Maybe this gets thrown into the relationship where it's like, oh, that didn't work out, right? We've talked about that. The bucket of relationships, in a rising rate environment, the change. Maybe this ends up being amazing for stocks, but we are closer to the edge of the cliff than we were a month ago. I'll say that.
You're just saying, like, hey, when we see the 10-year yield versus the 2-year yield uninvert for the past 40 years, that's been, whether you want to talk in a fundamental speak, recessionary, or you want to talk money flow and you want to say that's a removement of liquidity, or you want to say it's market risk and that's where we start to see equity correction, I think you're spot on. I think we've got to be aware of that. And if we're breaking important levels in equities, such as 4180 and a 200-day moving average on the S&P, or below 165 on small caps, or an index like EQAL, which is an equal weight Russell 1000, if we're below the October lows near $37, that's definitely something to pay attention to. And I'm with you at the same time. Does that relationship change if we're in a rising rate environment? I don't know the answer to that. And I also don't want to say something like, oh, this time is different, right? Because that's also a risk management red flag, is when someone says this time is different. And so it is interesting. And I would add that a chart you shared internally, TIP versus IEF, right, which is a way to look at inflation. Like you're looking at inflation protected versus a standard 7 to 10 year treasury.
Mm-hmm.
That's moving higher. And so now we're in an environment where,
well, look at floating rate versus IEF.
yeah,
I don't know if that has the same.
Oh, that's a great point. It's a tremendous
behind it, but I think it falls into that.
We still have rising inflation. And so now we go back to, why are we involved with markets? Are we involved with markets because they're fun? Are we involved with markets because they're our friend? Or are we involved with markets because we need to protect our purchasing dollar? And my answer would be C. That's what we're involved with markets for. And so do we get to protect our dollar using Bitcoin, or do we get to protect our dollar using gold, or do we get to protect our purchasing power using stocks or commodities? These are all great options, and that's why you have to use relative charts to identify where that best protection comes from. And isn't it interesting that you have a relationship like that breaking out with the dollar strong?
Yeah.
I find that fascinating.
I guess you could really, we haven't had much dollar weakness for the moves that we've had in some of these dollar sensitive assets. And dollar's kind of flat for the week, and yet you've got gold has made a pretty big move over the last, really 2 weeks. Really bottomed, 2 Fridays ago on the 6th.
Yep.
We'll see.
So out of commodities, we talked oil. When I look at something like TIP versus IEF, it makes me think of oil, which makes me think of energy, the sector, which makes me also think of yield, like MLPs that are providing opportunities. But what are we seeing in other parts of, it could be anything. It could be international stocks. It could be any areas that I haven't mentioned, whether it's bonds, equities, anything else, Ian, that you're seeing worth highlighting this week for our clients and listeners.
Do you want to talk about muni bonds?
We can talk about municipal bonds. I think that when you think about things that no one is talking about, I think municipal bonds are worth paying attention to, because they continue to be, in some ways, discounted at a pace that's pretty impressive. And yet, this goes back to your point about junk bonds. We're discounting them at less of a pace than treasuries. U.S. government bonds are being discounted faster than municipal bonds and faster than junk bonds.
Which tells me they have more faith in your local state government to, repay their debt. Junk bonds are probably not your companies with the best credit scores. There's probably not a credit, but you know what I'm saying. There's obviously not. I don't know if there's credit scores for companies, but you're most suspect of, can these people repay their debt or not? Even those guys are seeing more demand.
Yeah.
Than the stinking U.S. government.
This characteristic, which I think we've been highlighting for maybe 4 or 5 weeks now, is now, to be clear, all three things that we're talking about, U.S. treasuries, municipal bonds, and junk bonds, are falling in price. It's just the degree at which they're falling or being discounted. Junk bonds less than treasuries, municipal bonds less than treasuries. To Ian's point, treasuries more than the rest. Do we get to be surprised if there's a missed payment in the future, aka a government default? Sounds very scary. But all these things are aligning for that type of scenario.
Yeah.
I hate to be that guy, like the bearer of bad news, but the charts are showing that before the event, if there's an event. Now, I also realize that there's a tremendous amount of negative sentiment around long duration treasuries. You look at something like a TLT, and we're now at levels on TLT that go back to '07. We haven't seen these for 16 years, the levels that we're at currently. Do we pause here? Do we move higher? Or is it a inflationary environment? We continue to see rates rip. And now it's about making sure that we are participating in the relative strength in order to protect purchasing power. And in some instances, that does involve stocks.
Yeah. Could. Very well could.
Anything else? Anything else we've missed that we haven't touched base on, worth touching base with our clients on before we sign off here?
I don't believe so.
Okay. Well, enjoy your chili cook-off this weekend.
I will.
Noodles or no noodles?
No noodles. Wait, noodles and chili?
It's a thing.
Is it?
It is a thing. It is around here.
Noodles and like what kind? Just like
your elbow noodles, like your elbow macaroni noodles.
Okay.
You throw those in there. It's controversial around here. Like you just said, what are you talking about? Some throw it in there. Some have a bowl on the side. If you want to put some noodles in your chili,
okay.
You can. I don't have judgment either way. Rare is the day I found a bad bowl of chili.
I see this. In fact, all I Googled was noodles and chili, and the second link is a recipe for Wisconsin blue ribbon chili.
Yeah. I don't even know what the blue ribbon part is, but
As it won, and 3 years ago, this recipe won blue ribbon at a chili cook-off.
Yeah, it's a thing. You got your red chili, you got your white. Have you ever heard of white chili?
White chili.
Yeah, it's a thing. You might be a chicken chili, a white bean chili.
Turkey is that turkey chili.
Yeah, chili is serious business.
White chili.
Yeah, and it's good. It's good. My wife makes a mean batch of white chili.
And
she
that's
also
what
makes
chicken then?
Yeah, like chicken, maybe noodles, maybe not. Might throw some jalapenos in there. Some parts of the world call them jalapenos. But I love chili. I think I've rarely met. Have you ever heard of a chili dump?
What's a chili dump?
Okay, so everybody brings their own chili. You dump it all together.
Ugh.
Now, I will say that's dangerous. That's the only time I've had bad chili was when you dump the chilies together.
Is that also a Wisconsin thing?
I'm not sure. I've only been to one.
No, I wouldn't. Yeah, I wouldn't. That doesn't sound.
Yeah, why would you diversify chili?
Just have the cook-off. You can try like half a bowl of everyone's.
Yes, exactly. Why do we have to play games with the chili?
I have a confession.
Uh-oh.
Mom knows this. My wife knows this. I really don't like tomatoes in my chili.
What? Isn't that a core ingredient?
It is. It absolutely is.
Wait, so you just like the meat and beans?
I like meat, beans. You can put peppers in there, cheese,
So do you not like sauciness of it, or like?
No,
so
I like the
sauce.
Like I'm fine with the sauciness. I don't know.
Because doesn't the tomato give its sauciness? Maybe you just invented something. Maybe you just made dry chili.
Okay, I wouldn't call it dry, Dave. I mean,
well, we could also just call it tacos. Throw it on a tortilla. I don't know. So
there's got to be other. I know, like I get it. It's.
So will you have pizza with tomato sauce?
Like, you can put like lots of things. Bean, right? Yeah, you can put everything still in it.
So is it good?
Yeah, it's just chili. It's everything.
Well, is it though? Is it chili?
Just minus like the cooked tomatoes.
It's dry chili. I've heard rumors of this.
I mean, it's good. I mean, if you put chili, okay, when you go to a baseball game and you're like, yeah, get chili on my hot dog, it doesn't have tomatoes in it.
Well, it might for the sauce, like the base. It's a great question though. Okay. So you're saying what you're talking about still has a sauciness to it. Like
I Googled no tomato chili.
Okay, that's a thing.
Kind of scene.
Okay.
There's a lot of.
Is it pictures of houses on fire and stuff?
No, here's a real saucy one.
Okay. Okay. Well, I guess it's probably, I mean, William Devane probably approves.
Yeah. Because a lot of the sauciness just comes from like the beef, right? Like
some of the oils off of the beef, some of the
grease,
fat.
Yeah, to be honest. Yeah.
Okay.
Grease.
Okay. You don't like cooked tomatoes either. Do you like tomatoes on their own? You have a salad. Yeah. We talked about this. We like salads. You put tomatoes in it or not? Or you just tomato hater? And that's okay.
I'm not a tomato hater. Like I like ketchup. I like obviously I like pizza. I like tomato.
Wait on your chili dog, you put ketchup and then the chili on it?
Oh yeah.
Well, what? That's tomato.
Yeah, it is. I like ketchup.
Okay.
I like ketchup. I like tomatoes on my hamburgers. I like tomatoes on my BLTs.
Okay.
Like tomatoes and chili just have like I don't know. It's just I've been that way since I was a kid. I don't know if it's like a texture thing.
No, I get it. I understand. You got to have your preferences. I ain't going to hate. I mean, the noodle thing is different for people, but I do appreciate that we can give this episode a great title using this information. But as we wrap it up, I appreciate this confession that you've given on the adaptive team. When we think about risk management and markets, we are seeing some of these tools that we use to manage risk come closer to being used. And our clients are familiar with, if we've got an orange line below a blue line, we're going to move to cash and T-bills. Whether that happens next week or not is to be determined. We're at important levels across many different indexes. We continue to observe those and manage accounts accordingly. Do we move higher next week against these important levels? Only time will tell. The Lord only knows. But we will continue to adapt to the market environment. Otherwise, Ian, great to have you on here. Much appreciated.
Have a great weekend, everyone.